Welcome back. The stock market hitting new records in May, but E-Trade reporting its trading plummeted double digits last month from the prior month. So where are the retail investors and what will it take to get them back into this market? Joining us now is Tom Lydon. He's CEO of ETF Trends, along with our very own Bob Bassani. Welcome to you both.
Thank you.
Tom, look,
Thanks.
We wanted to talk to you specifically to see if there's something with ETFs that's driving this drop in volume or not. Can you explain?
Well, it's been a slow, steady ride. If you want a quick snapshot, look at Charles Schwab. They're the largest custodian of ETFs, over $200 billion, and they continue to see ongoing growth, 20% just this last year. It's been amazing.
So this is an E-Trade problem, is what you're saying?
Well, I think E-Trade tends to have more active traders, although Schwab has a trading activity account as well.
This is a great point, Bob. Is it the active trader that's not as active, and maybe the buy and hold mentality is back?
The structure of ETFs does make it very easy to trade the ETFs without trading the underlying stocks. So there's a little bit of a point here that ETFs are contributing to lower volume, but this has been true for many, many years. There's something else going on, Tom, that's a little bit bigger than this. You've got to admit, it's a little strange when we see volatility going down as the markets are hitting new highs. I think the trading situation is telling us that the economic outlook is uncertain. The markets are at new highs. And most of the people I talk to, you talk to active traders, they're flattening their positions out. They're not as long as they used to be, and they're covering their shorts a little bit, just flatter, because they're just not certain about what's going to happen in the next 3 to 6 months.
Well, you're right, Bob, but one aspect to that is active traders are only a very small percentage of the marketplace. If you look at the average investor out there, they're wrapping their arms around ETFs and embracing them in a way where they're kind of running from.
I mean, ETFs can be a lot of things, right?
They sure can.
They can be just like a cheap S&P 500 tracker, or they can be a double leveraged product that you're in and out of in an hour.
Yes.
Right. There's no doubt.
Is it possible that investors that were whipsawed, that are going into retirement now, baby boomers, that saw what happened to them in 2000, 2008, 2009, 30% declines, maybe they pulled their horns in perpetuity. Maybe they don't want to take a hit. Maybe they'd rather have no returns than risk their capital going into retirement. Is that a possibility?
Yes, we have all become behavioral economists as a result of 2008. No more classical economists would buy low and sell high.
No.
Right. We're all acutely aware that the pain of the loss that everyone suffered in 2008 is much greater than the expectation that we'll have gains from the market hitting new high. How else do you explain we've hit new highs, and yet the overall participation amongst the retail trader is still very low? The public is not emotionally engaged in this historic rally that we've been having. It's been the most frustrating thing for all of us here at CNBC, particularly for me as the market reporter. That's the obvious answer.
Don't take it personally, Bob.
Well, I do.
Bob, I think you're absolutely right. I think that, Kelly makes a good point about, are people much more long-term focused right now? And I think if you look at last year and the tremendous rally we had last year, the fear of being on the sidelines and missing it, people got very long-term oriented, I think, under those circumstances. Missing, when you look at the massive catastrophe we had a few years ago, the people that held on long-term and rode that out are the people that performed well, and obviously they weathered through it.
So this is a change for the good, David, if this is the case. But I guess it's a threat to people whose business models are built on churn.
Absolutely. Look at, these hedge funds that are hoping to have more volatility so they can boost up their returns. It's not there. It's
leaving the elephant out of the room, though.
Yeah.
The elephant is the Federal Reserve.
Yeah. Well,
and if you've had this consistent interest rate policy, it's dampened the volatility, and it's changed the game from the way we all learned how to play the game growing up.
That's a great point, and that's a really good question. How much is the Fed responsible for exactly what we are seeing right here? Dudley said it this week, Bill Dudley, the New York Fed head. He said, I'm a little concerned about the markets because there's so much complacency out there. People may be taking too much risk. The head of the New York Fed actually said the low volatility may be making people take too much risk. I don't necessarily agree with that, but I do think the Fed bears some responsibility for this weird system that we've got right now. Very low volatility with the markets at a new high. That doesn't usually happen.
Echoes of 2007.
Yeah.
We'll leave it there for now, guys.
Okay.